Retirement planning should be more than just talking about investments. You want the confidence to enjoy this special time of your life. If you want more from retirement, you've come to the right place. This is the Marc Oslar Retirement Experience, the financial pathway to more.
And welcome once again to the Marc Oslar Retirement Experience. My name is Randy Cook, and each week we sit down here together, me and Mark, and talk through some of the things that are going on out there in the economy, in the markets, and boy, there's a lot to talk about again today. And then we ask the question, what do you do about it? How are you positioned right now when you look at your iPad and you open up Vanguard and you see that you've lost $40,000? That can't be a good feeling. And then you start to say, what if this happened to me in my retirement years? That's not what you want. So let's get that taken care of. We'll handle that right off the bat here. Mark, how are you doing today?
It's a great day, Randy. I've just had such a great time doing this with radio with you for over 8 months, and we're going to do this for some years to come. I know you say you're talking about retiring, but you got to cut that back a bit.
As everybody say, you're going to retire. We're actually going to talk about that today when somebody looks at you and says, why aren't you retired? You look like you should be retired. You got a mindset you want to retire, but then some of us don't retire, and there's got to be some reasons for that. And maybe we can give you some reasons that you can retire today as we go through all this. Well, up and down markets, I mean, we have lost, 10, 15, and in some cases, some of the indices 20%, even into a bear market territory, Mark. So this is that time. So let me ask this. I mean, this is what you do. You say, hey, when you come in, let's put a floor underneath this money. How many calls are you getting? Is anybody saying, Mark, I'm panicked? What's going on right now?
Randy, yes, there was I'll just say record calls on Thursday and Friday. We were receiving these calls, and I'm talking about last Thursday and Friday, okay? The 2 days where we saw some corrective measures in the market, and folks were freaking out because if you combine the S&P 500 losses over a Thursday and a Friday, it came to about 10.81%. Yeah, and that's quite a bit. Now that's just the average based on the S&P 500. Now you talk about the tech industry, it got hit pretty hard too as well, and it's just on everybody's mind. Where are we at this point? And these are the conversations we're having now, Randy.
Well, one of the things that we watch certainly is the financial news, the economists, and all their take on this whole thing. And there's one thing when the market goes down, like what we experienced in 2008 or we experienced during COVID. And some of those things are seemingly out of our control. And then there are people that are saying, hey, this is completely in our control. This is self-inflicted. We have shot ourselves in the foot with all this tariff talk. And so now they're talking about a recession. Goldman Sachs, Moody Analytics, and others, it's somewhere between 40 and 60% a chance that we will go into a recession this year. So here's a little sample of what they've been talking about on the financial news networks.
Everything's kind of moving in the wrong direction. The orders contracting, employment contracting, and prices increasing.
Everything about this economy is good. Everything, except one thing. We have a president who's very angry at everyone, and his wrath has made investors so downcast and so negative that people have just given up.
I don't want to be alarmist. This is not necessarily going to snowball into a recession in 6 months. But why would you be doing this in the first place?
I love that guy. Okay, so that's a good question. I think we all know that we want to even the playing field when it comes to world trade. That's the whole idea here. But is this medicine a little too bitter for our market, and can we recover from this? What's your initial take on all of this?
All great questions. And I'll be honest with you, just up front, when you listen to those takes, most of those were emotional takes. And truthfully, when you make a decision financially, you don't want it to be an emotional one. Because if you make it too emotional, what's going to happen is you're going to make the wrong decision. So for me, am I one of those guys that says, hey, Randy, we lost 10, 15, 20% in the market. Stay still. It's okay. They're paper losses, all that stuff. No, I'm not that type of person either.
Glad to hear that.
Yes. Look, I'll give you two different schools of thought. I had one person come into my office. We sat down. We discussed the overall situation. We ran a report for them on their holdings, and we just talked about things. And the thing that scared me, I think, was that in their holdings, they didn't have really any savings. and everything was in the market. They're living off of this particular income. So when you have a Thursday and a Friday like we did before, and you're taking income from it, we call that the double whammy, because then it really pulls down your account even further. And then it's a little bit more difficult. We talk about that on appointments. We talk about sequence of returns, because when you have sequence of returns, when you're taking withdrawals from those returns, they're returns, right? But the returns could be negative. So when you flip out those returns, the same returns over a 10-year period of time, but a different sequence, and you're taking withdrawals, there could be a drastic difference in what you have left 20 years from now. So these are the things that we discuss. And then there's another scenario or school of thought where a person gave me one appointment. They never came back. They were going to come back, never came back. They traveled and traveled. I texted them the other day, and now they said that an annuity is not at the focus of what they want to do at this point, even though it was several months ago. And I thought to myself, I don't understand this school of thought, because this is actually a time where it would be a great time to have a conversation about an annuity in a portfolio if you want to make some preservation tools and maybe some income provisions.
Yeah, inside and outside the market. If you're looking at your holdings right now and you're down a lot, that might mean you have too much risk. And, I'm glad I hear you say that you're not the guy who's going to sit there and say, hang in there, it'll come back. And that may be true, but that's not real comforting to somebody who's in retirement and taking money out while the money is going down. So what I kind of think about, what I want to do with my financial advisor is, I understand that there's risk, there's up and down in the market. But when the market is down 10% and I'm down 10%, that means that this isn't good management. If the market's down 10% and I'm down 3%, now I've got some confidence. Now I feel like I'm positioned correctly, and you're doing your job and I'm doing my job, and that makes me feel a lot better. I got to believe that that's part of the conversation right now, is kind of dialing back that risk.
It really is. And that's the point, because as you brought this up, there are different phases in life. Now, when you're 35 years old, you're in that accumulation phase. You're just trying to make as much money possible. Mm-hmm. You hit 65 or 70 years old, the older you're getting in that category, the more you want to preserve what you worked your whole life for. And then, of course, maybe distribute it, whether it's to you or your family or both. These are the things that come up. And then, are we doing the right estate planning around all of that? I will confer and talk to attorneys and bring people into the attorneys to do all of the legal work. And we all work together to make sure the process is sound. So, Randy, all of that matters with regards to retirement planning. And as a financial advisor, I can say this, that no, I don't want you to just sit there and feel like you have to take those losses. I want to make sure that you feel confident with what you have in front of you. And the one thing I always want to do is, if a person comes to me and they don't feel like they're in control of what they got, I want to give power back to that person.
So important that you not only know what you have in your holdings, that you understand them, that they have a purpose, and that when things like this happen, you don't get stung to the point that, you have to make a lifestyle change in your retirement years. That's the kind of plan that we talk about here on the show with Marc. Give us a look on our website, moretoretire.com, moretoretire.com. If it's time to talk about this, let's get an appointment. And that is, of course, at no charge. We're going to sit down and just get to know you and figure out what you want to do in retirement. Take a look at where your money is, and maybe there's some places we can help you. moretoretire.com is our website. There's a form filled down at the bottom of the page there. You can put a little information in there, and then we'll reach out to you. Or right now, you can just reach out to us. Here's our number, 984-300-1984, 984-300-1984. So let's dive into how we're going to talk about this risk. And the way that I'm going to get here is kind of something interesting. Here we are in North Carolina, and you'll see a car go by with a plate from Virginia now and again. And on there, their slogan on their license plate is Virginia is for lovers. And they have a little heart on there. That's very nice. But apparently, Virginia is not for speeders, because in the state of Virginia now, if you get caught reckless driving or a repeating person who speeds all the time, they are looking at an idea to put a governor on your engine so that you can't go faster than the speed limit, which is kind of interesting. So when I thought about that, it is a little like what you do, Marc, putting a governor on our portfolio. we don't want to be running so fast and so into the market and in so much risk that we want to hold back and keep a limit on that. So what are the steps that you would take when somebody walks in and you say, I don't want to be heavy market, I don't want to experience all those losses, you be my governor?
Usually I first say, okay, let's just sit back, relax, have a nice chat. Let's get to know each other a little bit. And let me just understand and identify what you've done up to this point.
Okay.
And then where you want to go from this point in time. I want to know about your goals and your dreams. I want to know about what's going to be the necessities in life for you in your future. And yes, we want to have that governor on it because we want to make sure that you feel comfortable with what you've got and what you're going to move forward with in terms of your allocations. Because I'll be honest with you, I really don't know when I first sit down with someone what I'm going to recommend. I'm not a one-stop shop where we just sell stuff. We just don't do that. You know, we're consultants here. You come in and we really want to get an idea of how we can help. Helping a person is the most important thing. So let's say, for example, somebody comes in, they say, I hate annuities. I don't want an annuity. Well, you know, I get that maybe 1 out of 10 times, about 10% of the time. When I get that, that's not difficult to work with because we do portfolio management, but what kind of risk do we want to take in retirement? Right, Randy? So these conversations come up. So obviously we want to build some stuff into the portfolio that might be able to pull away from that degree of correlation that goes in the same direction. So a lot of times we'll have conversations about structured notes to do things like that as well. So we talk about income planning. We talk about correlation. We talk about risk tolerance. But then for the other 90% of people that don't mind building annuities in their portfolio, it's just a great retirement tool. They're very illiquid products, I will be honest with you. So you don't want to put a bunch of money in annuities. You want to put the right percentage based on whether it's a need for income, whether it's a need for living needs benefits, which are similar to long-term care, but they're not long-term care, or whether it's for a specific purpose for estate planning through an attorney. These are the conversations we have, Randy. And when we start at the beginning, I have no idea where it's going to go, but normally we go through our 5-step process on our website.
Well, when we talk about what you're up against in retirement, many of us think we're up against a stock market, which is what we're experiencing right now. There's other places things that you're up against. You're up against taxes. You're up against long life, that you would run out of money, those kind of things. There's all sorts of what we call headwinds. But what are your goals here? Is your goal to beat the S&P? Is your goal to beat the Dow? Maybe your goal in retirement is to say, I want to take my whole family to Disney World. I want to take them to Hawaii. I want to go on a Mediterranean cruise that lasts a month. That's really what your goals are in retirement. So, I mean, all this stuff can be going on around you, Mark, but while you're in retirement, maybe our focus should be elsewhere and what we want to do. And as long as we've got a plan to help us what we want to do, let the world go round. I mean, seriously.
Yeah. I mean, truthfully, Randy, you're right. I mean, I had another person come in, first time visit, and we went over how they're in market positions. They feel like they're underperforming. They're in an actively traded portfolio, which is also the things that we do as well. We're not passive, we're active. Active or not, they're not the cheapest in terms of fees, okay? But this particular outfit charged higher fees than we did. I'm not going to get into the details here. I'll just say that she's still not performing to the benchmark based on identification on the report. And then in addition, she had a variable annuity and didn't understand that that's not under the insurance laws. That does not fall under the insurance laws like a multi-year guarantee annuity or a fixed annuity or fixed index annuity, which do fall under the insurance laws. And so that's what we had to have a conversation about, because if you identify and understand the difference between the two, then you can identify what your needs might be.
Well, we would love to have the opportunity for you. This might be one of those times when you kind of, slap yourself in the forehead and say, I've been talking about going to see a financial advisor and maybe now I should. And now you're down 20, 30, 40, 50,000. And it's like an emergency. It's like a flare's been shot up. And this is a sign. If this is making you crazy and you know that you are going to retire in the next couple of years and you don't want to retire in a down market, you're probably going to see 1 or 2 or 3 or 4 of these things during your 20-year retirement. Let's sit down and have a conversation about this and stop the losses if we can and build a plan so that we don't have to deal with this in the future. Here's our number and our website, moretoretire.com. It's moretoretire.com or 984-300-1984. Let's get a date on the calendar. 984-300-1984. So, Mark, you've also already talked a little bit about what financial advisors will say during times like this. I actually have a couple of things that are quite common for financial advisors to say, and I don't know that they're very reassuring, to be honest with you. Number 1, cheer up. Now you can buy your favorite stocks on sale. Number 2, this is a healthy market adjustment. Just ride it out. And don't check your portfolio every day. It'll make you crazy. They suggest that you take your client and say, look at what you've done over the past couple of years, and now look at what you've done over the last couple of months. You compare those two, and you feel a little better about yourself. I think, if I'm in Las Vegas and I'm playing blackjack, I've got 2 stacks of chips. One is my money, and one is their money. And I'm more likely to bet with their money than my money. So let's talk a little bit about what you would say. And are these things here that what a financial advisors say, it just doesn't feel good to me?
These are very common phrases. These come up all the time. And I've had several folks in my office last week. We had some discussions about what was happening on that Thursday and that particular Friday. And, one of the things that was of concern to them was they didn't want to look to see what their values were. Mm-hmm. They really didn't want to, so they had that concern right away. I thought, you know what? Let's just get it out of the way. Let's find it out. Rip the Band-Aid off and find out what's going on. Because you know what? If we understand your risk tolerance and what you want to accomplish, then some things won't be a worry. And some things, they're just going to be different. Just depending on your age and your risk tolerance, what you want to accomplish. So with me, am I going to tell you, oh yeah, just ride it out? No, let's have a real conversation. Let's not get overly emotional about what happened those 2 days, but let's come back together and decide of your current portfolio that's in the market, what percentage of that is that? And what was our discussion originally? Were we trying to do accumulation? Because if this is only like 15% of what you're trying to accomplish, then I don't think we have a lot of concerns. But if this is 85% of what you're trying to accomplish and you're too high in terms of, risk versus reward, the things that worry me are, can you take that type of risk at this point in time? So we like to have this conversation and talk about long-term goals. Mm-hmm. I have no problem with jumping back into the market a little bit more when things dip down because there usually is opportunity. Even if it dips again, it'll probably come back and you'll probably make money off of this. And because you jumped in now as opposed to what you lost before, you probably have a good chance of making some extra money. With that, Randy, you don't necessarily have to take that type of risk. I talked about how interest rates were kind of terrible in 2019, 2020. And so a lot of insurance products were priced out of the market. Annuities, maybe they're older annuities that were dated back then. And like I said before, things are so much better now with pricing because of interest rates where they're at that you can get out of those types of products. And things are just at an all-time high. We have great opportunity. And then I talked about, Randy, we've had this conversation before. We talked about bonuses and annuities, right? Mm-hmm. Yeah. There are what we call fake bonuses, which please be careful because when you hear somebody say you're going to get this roll-up of 7% or you're going to get this 30, 40, or 50% bonus, I can tell you that those are income bonuses. They're not really your money. You're not going to walk away with that money. I just want to get that out right away because this is a very confusing thing. It is shared incorrectly with people all the time.
Got it.
There are real bonuses that are as high as 20-something%. They are out there. They do exist, but you have to know if they're the real ones or not. And sometimes in these particular cases where you lost 15% in the market, maybe we should just have a conversation and talk about where you're at and do we want to look at these preservation tools?
You're listening to the Marc Oslar Retirement Experience. Online, you can find us at moretoretire.com. That's, again, moretoretire.com. At the bottom of the page, there's a place where you can put in a little information, name and email, phone number, that kind of thing. So Marc will reach out to you. There's even a box there that'll say, this is what I'm really concerned about. This is what I want to talk about. And this market really bothers me. I don't know what I'm going to do about Social Security. How does my 401k become a paycheck? All of these are really good starting points for our conversation. Check that out at moretoretire.com or 984-300-1984. 984-300-1984. Well, we talk about income, and replacing your paycheck in retirement is probably job number one. That's what we got to do. We got to have income in retirement. JP Morgan did a study about how people spend and don't spend their money in retirement, and they found that if you got 20 to 40% of your income from a pension or a pension-like source, people would spend about $50,000 a year. But if you got 60 to 80% of your money from a pension-like source, you would spend $71,000 a year. So, Marc, there's a confidence level there that's with one group, but not with the other group. What do you make of this? Why do you think this is?
When they look at their pension, they almost feel like it's guaranteed. Mm-hmm. And I don't want to use that G word because truly, even though you have some backing with the Pension Guarantee Act, we talk about these things.
You just don't know, do you?
You don't. You don't know, because I've seen many people now have to take lump sums from a pension where they can roll it to an IRA and stuff, just simply because either the company went out of business or the fund is drying up and they have to do something different. Mm-hmm. And this has been happening and it's been occurring more often than I've seen in the past. So with that, it just means it wasn't basically when these companies did pensions for these clients, these people that were working for the companies, they put them into annuities, and these annuities were immediate annuities. So they would guarantee to pay a certain portion of money at some point in the future. But maybe the insurance companies got hurt during this process too as well. So we do need to be cautious of using that guaranteed word. What I really want to do is focus on how we can give you something of a better preservation tool. So if you have a lot of people in these pensions, they just think it's bankable money, they're comfortable, and they feel confident spending that for the rest of their lives. And the people with less, they're going to spend less. They are more focused on how they control the rest of their assets. And these are conversations we have, and everybody has a different investment strategy and different risk tolerance. And we just want to identify that and assist you and help you along the way.
You use terms about buckets of money. In financial advisors, they use this whole idea of buckets of money. And in that income bucket, if you feel and you're confident that bucket's going to be filled up every month, just like Social Security, just like a pension, an annuity, those kind of things, people feel more confident about that money. And they feel that I can spend confidently because that bucket's going to be filled up again next month. So that's the kind of thing that we want to build for you in your retirement plan. Give us a call. Give us a look on our website. Let's talk about replacing that paycheck. Let's talk about that challenge of, I made this during my working years. Can we create that same amount of money in my retirement years? That is a big challenge, and that is the one we're going to take on for you. Give us a call. Give us a look on our website, moretoretire.com. Again, that's moretoretire.com or 984-300-1984. 984-300-1984. I found an article that had a picture of all these billionaires out there, and they say, what are these people doing to hedge against a recession or a market downturn? They got a lot of money at stake there, right? And it said most of them are investing in art. And I can't see myself buying a Picasso anytime soon, Marc. If I had that amount of money, I don't think I would be worried about retirement at all. But the fact is, maybe we can learn something from that concept, and that is art and those kind of things, having assets, are outside the up and down of the stock market. So for us everyday normal people who aren't going to go buy a Monet tomorrow, we can buy land, we could get real estate, we could do CDs, we could do fixed income of some type. So in your typical client retirement plan, how much, can you give me a percentage? Is there anything that's common of what's in the market and what's out of the market?
Yeah, Randy, my personal rule of thumb I like to use is the rule of 100. 100 minus somebody's age tells us the difference of how much you should have at risk. And folks will come to me and say, well, it's not all risk. I got some bond funds and this and that and all that. It's still in the market. So it still has risk. And so what we want to do is look at things preservation tools. And we talked about this specifically. For example, like a structured note, you could break up some correlation, and some of them might have some more preservation tools than others, just depending on if one's buffered versus one says, we'll promise you your principal back. And it's really up to whether the bank fails or not. But a lot of times they use those banks that are the huge banks. Okay. So we talk about those things. Then we're talking about, let's just say CDs, or we're talking about treasuries, money market accounts, also preservation tools. And then annuities, but not variable annuities. We're talking about fixed indexed, multi-year guarantee, those types of annuities. And the difference is if you're 65 and we take that 100 minus 65, more than likely, it's very common to have 35% in the market and built in depending on your risk tolerance. So that's just a good general rule of thumb.
You and I have talked in the past about gold. And right now, when the market goes down, gold, you see commercials all over the place, not only on radio, but on TV as well. And they're saying you should get into gold, which is a commodity, which is outside the market. It performs well when the market goes down. Right now, gold is up 15% up about like around $3,000 an ounce right now. So are people asking about that when these things pop up on TV? They say, Mark, how can I get into gold? How much of my portfolio should be in gold? How do you answer that question? Yeah,
no, that's a great question, because I should have brought that up too, because commodities like gold and silver, gosh, talk about preservation. Yeah, I had a client come to me back in 2020. He was concerned and he wanted to buy some gold. I said, in terms of owning it, it's gone way up when inflation was going up. So it was a way to preserve your assets against the rate of inflation. And then silver's used in so many different things and so much trade that it's always valuable to own. So it's a great point, Randy.
So do you encourage people to actually own physical gold? Like, I'm going to have, an ounce that I could hold in my hand? Or is it better to go to an ETF that deals in gold, or a mutual fund or something like that?
Well, a lot of times when we build a portfolio in ETFs, it will have some commodities built in, but that's not really like owning gold or silver. And let's just say if it's in an IRA and you have a custodian involved, you can still put it at a storage facility as well. So at least you're still owning the physical commodity itself.
Gotcha. You're listening to the Marc Oslar Retirement Experience, talking today about, the markets are kind of crazy. We've all probably lost some money. If you haven't, good for you. I know I have. And but what do we do during times like this? And this might be that red flag that you go, I meant to call him. I didn't call him. I got to call him now. Okay, we'll call Mark and let's talk through all of this. 984-300-1984. 984-300-1984. Or use our website, which is moretoretire.com. So we try to make sure that you're updated on things that can happen in your financial life. And one of the things that might happen is there might be a new addition to your 401k. We've talked about this over the years. Annuities are now starting to be sifting into 401k plans. Bitcoin, actually, some people are making an offering there that you can invest there. And I got a new one for you. It's private equity. Private equity is now wanting a place in your 401k. Now, I don't know what that is. So you got to tell me, what is private equity? It sounds risky to me. Is this something that someone in their 50s or 60s or 70s should be interested in if that pops up in their 401k?
Only for a very small percentage. So let's just talk about, the difference between venture capitalists and private equity. The difference is the amount of money on the private equity side of folks. They're a group of people, groups of businesses that are actively investing in things, and they're looking for big returns. And so let's just say, for example, you're attached to some type of private equity fund. There's going to be risk involved. And it's a different type of risk. Now, with that, it's not bad to own some of it, because what it'll do is it'll break up, like what we talked about, the C word, remember, correlation? It can break up your correlation because you're not attached to the same market vehicles that you're currently attached to. So it couldn't hurt to have some money there. You just don't want to put a bunch of money there. And venture capitalism, the difference is really venture capitalism starts from the top. They like to invest in things really early on and make the gigantic return later.
So these are not, you're not getting into a stock that's on the index. It's not in the Dow. It's not in the S&P. These are companies that aren't there yet, and they might be startups that people think this one's really going to soar, so we're going to put a whole bunch of these in a bundle, and we're going to make it some kind of an offering for you. And that's a whole different kind of investing, isn't it?
It is. Private equity, they're constantly in mergers and acquisitions. They're looking to buy companies all the time, and they do it based on a percentage of risk and then a percentage of what they think they're going to return from it, and they're going to get the majority of the return and give you the rest. So it's not far off from the way mutual funds do it, but the difference is it's totally different risk. You're not dealing with these big public companies.
It's another reason to give Mark a call when things pop up in your 401k and, somebody from HR says, hey, we have some new things. You need to go in there and check that out. You can call our representative from Fidelity or whatever like that. And then they never come out to the office. So you need to check these things out to make sure that they're right for you before you start allocating things in your 401k. So it's a real good resource. Use Mark as that resource for you, and among other things as well. I mean, it's something as simple as should I buy the car? Should I rent the car? Should I buy the place on the beach? Should I rent the place on the beach? I mean, these are the questions that you can bounce off Mark as well. Everybody wants to know, can I do this without running out of money? Here's our number. Here's our website. It's moretoretire.com. Moretoretire.com or 984-300-1984. It's a complimentary appointment with Mark to sit down and talk about your retirement, what you've done, what you want to do, and can we put the money together with those things you want to do. 984-300-1984. So we talk a lot on the show about 401ks, and you probably heard about this idea of a conversion. All that money in your 401k, when you take it out, it's going to be taxed. What if you were to take a little bit out at a time and pay that tax, and then by the time you got into your retirement, you didn't have to worry about that anymore? A lot of people are using that particular tactic. This is Christine Benz talking about the IRA to Roth conversion.
If you're working with an advisor who is tax savvy, he or she can tell you how much you could reasonably convert each year to avoid bumping yourself into the next highest tax bracket. They should also be able to give you some advice about whether it even makes sense to convert. So if you're still earning a good salary and working, it oftentimes doesn't make sense to do those conversions, but the period just after retirement and before those required minimum distributions start, that is a really fruitful period to consider doing some conversions.
All right, so she brings up the timing of it, when to do it, how much to do it, and why you don't want to make this mistake, because getting into the next tax bracket could cause you some extra taxes. So, Mark, talk to me about when you do an evaluation of someone and say, you would be a good candidate for this. How much? When do we do it? How do you figure that math out?
It's different in every case, and I'll say this: Christine Benz, she hit the nail on the head. It was well spoken, and the thoughts spot on, Randy. This is what we do. So we sit down and talk about how much traditional stuff you have, 401ks, whether it's traditional IRAs, SEP IRAs, the taxable events, right? And then we talk about the income tax free money like Roth IRAs. And of course, within the parameters of the Internal Revenue Code. So we have to factor that in. Of course, 5-year waiting period upon conversions, things like that, even, opening a Roth IRA, those types of things. So we obviously want to make sure that we're given the best and highest possible advice. So required minimum distributions, that's a big one that comes up. We talked about how all the way up, dates of birth that go all the way up to year 1959. Those are the people that have to take a required minimum distribution by the age of 73.
Got it.
Everybody 1960 or after can take it at age 75. So based on that scale, that also gives you your period of time of what you feel comfortable converting, because once you hit required minimum distribution age, you can still convert. You just have to take your required minimum distribution first. But do we want to see, if you're really considering, converting money to a Roth IRA, you really want to have these conversations, we definitely want to look at your adjusted gross income. And then we want to involve a tax advisor at some point as well, just to confer with them and make sure that we're all on the same page about not trying to jump you into a higher tax bracket. And if you're comfortable going to a higher tax bracket, maybe not jumping into one after that. But I can tell you that when you do the factoring and the conversions, later on down the line, it becomes very attractive for the person.
So I have a million questions. So here we go. All right. So let's just say we use that $1 million figure all the time. So you have $1 million in your 401k. And when we sit down with you and you do the math, are we converting all of it? Or half of it? What goes into that of how much? Is it okay to be in your 70s and 80s and still have a traditional 401k where you're still paying taxes? Or do we want to get it all out of the tax wash?
Yeah, I mean, essentially, anybody has a 401k in retirement, we definitely want to at least roll it to a traditional IRA. So get a rollover IRA opened up, because we want to open up the avenues to a lot of other investments you don't have in your 401k. Mm-hmm. Then you got $1 million IRA or 401k. Do we want to convert that all at once? Probably not. You're going to be in the highest effective tax bracket, and you're going to pay everything possible that the IRS wants you to pay based on that income that you take, because it counts as ordinary income.
Yeah, they'll put you right up into the 1%, and then now you're paying the top of the dollar as far as tax rates are concerned. How fast, how long a period of time does that person who has to start taking RMDs at 73, do we want to get it all done by 73? Or could we say the timetable brings us into our retirement past 73 and we can continue on in retirement? It seems like that would be a smart thing to do, because income levels would be down, which means tax levels would be down.
Yeah, because if you do a conversion after taking an RMD at age 73 or 75, at least you're still getting more out of there. And then at the same time, you'll have a lower required minimum distribution each and every year as you do that. So that's a great school of thought to do that. And if you want to accomplish it all beforehand, I'm sure we can devise a plan that looks like that. Just depends on what you can handle or not handle with terms of paying taxes.
And paying the taxes, we always want to have another fund. We want to have a savings account or something else to pay those taxes, because if you say, I'm going to convert $100,000, but I need to take $140,000 to convert that, you're just kind of hurting yourself, aren't you?
Absolutely. So it's always good. And we talked about that word, the L word, liquidity. It's so important. You need to have some money on the sideline. You don't know what's going to happen in life. We might need to make certain decisions on the spot. And I certainly don't want people coming to me saying, hey, I need to get this, I need to get that. Well, what did we do? Did we not get enough money sitting there for you for the just in case, for the taxable events, all of those things? And yes, and when we do the conversions, you can also do the tax withholdings directly. Usually almost everything that we do, we can do that.
You're listening to the Marc Oslar Retirement Experience, talking about 401ks and the idea of getting some of that money that you have in that 401k out of the tax wash, so that when you take that money out to use it, you don't literally have to pay a toll to get your own money. You've already done that, and that's part of the preparation process of getting into retirement. And one of the reasons I think it's so important to get with Marc a couple of years before you retire. So don't put it off until you're 6 months away from retirement. Walk into the office and say, with your chest out, I'm ready to go. Well, that's okay. That's okay. But if you came in 3 years ahead of time, that would give Marc a whole lot more time to do things exactly like we're talking about right now. Give us a call. Give us a look on our website, moretoretire.com. Moretoretire.com. Down at the bottom of the page, there's a form filled down there. You can put a little information in. Marc reaches out to you. Or you can reach out to us right now at 984-300-1984. 984-300-1984. All right, so kind of a sad story that happened this past week. Val Kilmer passed away, and he's such a great actor. He was only 65 when he died. Of course, he was in with Top Gun. He played Jim Morrison in The Doors, and my favorite was when he was in Tombstone as Doc Holliday. Here's a couple of my favorite moments from that.
You must be Doc Holliday.
That's the rumor.
You retired too?
Not me. I'm in my prime. Why, Johnny Ringo. You look like somebody just walked over your grave.
I'm your Huckleberry. Such a good movie. I watch it every time it comes on. It's so good. But, all right. When he said to him, I thought you were retired. And he goes, I'm in my prime, which I love. There are people that come up to me, and say, oh, why aren't you retired yet? You look like you could be retired. I don't know. There are people that could be retired, but aren't retired. And sometimes people continue working when they don't even know that they could be retired. So let's talk about that person a little bit that comes in your door. You do the math and you say, why aren't you retired? You could retire right now. And is a hard thing to get them to pull the trigger on that? Many times people go back to work for a little while until they get to that point where they go, I can't stand one more day. Mark told me I can retire. Now I'm going to finally do it. Well, talk to me about that.
Yeah, I mean, there's guys that maybe you want to be the country club guy and golf all day. I get that. That's a wonderful thing if that's really what you want to do in retirement. But if you want to go out and you just have, you want to contribute to society and get involved in a lot of different charities and churches and things where you can do really good in life, and that's how you want to spend your retirement, that's great too. I know you want to have travel plans and do these things that, Randy, truly, I do want to find out, hey, could I tell this person they could retire? That's actually one of the most exciting things. Because when I figure it out, I mean, they're like, I don't think I can retire till I'm 65. And then I'm looking at them thinking, they can retire right now. They're like 61. I'm like, you can retire right now. I could show you how. But maybe it is more conducive if you retire at 65. Maybe it does make more sense for you. These are the real conversations we have. We figure it out. We go over the numbers, and we have to include everything. We want to think about there is no such thing as a normal rate of inflation, but we want to involve inflation as a tool, as a mechanism to understand if we can or can't do something. Then we want to involve preservation tools. We want to involve income tools, and we want to figure out the taxable events in life. So we talk about every one of those things. And then, of course, we want to make sure that we get you in touch with the attorneys to make sure the estate planning is done. And just exactly what we think you probably should do with them. They're going to give you their legal advice, and we're just going to stand behind them, but we're going to be a part of that process. And then if you want some high-level planning, you need to sell some real estate. You got capital gains and things like that. Those same attorneys down the road have a CPA on staff that is an attorney as well. So there are tax advantage strategies that we could work on as well.
Well, let's just take that person you just talked about. You're 61 years old. Mark does the math on your retirement. You thought you were going to work to 65, and he said, you can go now if you want. And now imagine your attitude going back to work. You say you're not quite done yet with your work life. You go back to work with the knowledge that you can walk out the door anytime you want. Gosh, that's a powerful feeling, Mark. And I like working my last few years in retirement knowing that I can walk out anytime I want. That's pretty neat. I like that.
It's a great feeling. Now, I'll say this. I would just gather and say at least 50% of the people that I talk to do not want to do what they do for a living for the rest of their life, okay? And truthfully, they just don't. They don't love it enough. And there are some people that absolutely despise or hate their jobs. Let's get you doing something you want to do, because when you retire, I don't want you to just sit in the recliner, okay?
Yeah.
I want to see you doing some stuff because I believe all human beings need to contribute to society. So for me, as a whole, I want to make you happy in retirement, do the things you want to do. But truthfully, Randy, I want to see how much I can help. And being able to tell you can retire at a certain age, it's a great feeling. Now me, if I feel great in my 70s, I'm still going to do what I do for a living because I love it. I love helping people. I love meeting people. I love praying for people. I love being there.
Well, when your granddaughter looks at you and says, Papa, can you be my mystery reader at kindergarten at 10 o'clock in the morning on Thursday? And you can. That's a pretty good feeling. So think about that and give us a call. Let's talk through it. Let's talk about your retirement. Maybe you don't want to pull the trigger right now, but what if the math was there that you could? That's up to you, and that is a great feeling. Give us a call. Give us a look on our website, moretoretire.com. That's moretoretire.com. You can scroll down to the bottom of the page and put in a little information there, and our team will reach out to you, or you can reach out to us right now at 984-300-1984. And Mark, we have just a couple minutes left here. When they're on the website, they can also see the steps to more. Walk me through what that is all about.
Yeah, we always start with a treetop view because we don't want to overwhelm anyone. Now, if we want to combine, steps 1 through 3 and get it out the door and get started earlier, the best way to do it is to show me your positions in the market, because I like to run a report and identify certain things, especially if all your money's in the market. If it's not, we still want to identify all the other financial products you might have, whether it's banking or insurance. All that we're going to do at a high level. As we go through that process, we'll keep bringing you in and talking to you. It could be a 2 to 5 step process just based on what you want to accomplish and how quick you want to do it. But step 5 is always ongoing support because we're going to be there for you and we're going to make sure that we're going to give you the answers you need in retirement. So for us, the more time you give us, Randy, on our process and our process guide, I want you to read that on our website, moretoretire.com, the better. Give me some time. It would be great to get to know you before retirement.
Well, let's get started on planning your retirement. These financial times that we're in right now can kind of be a wake-up call for everybody that we're going to need somebody to walk through this whole financial realm of our retirement with us. Give Mark a call. That's really why we have this show, is to introduce you to him. moretoretire.com is our website. Again, moretoretire.com, or again, 984-300-1984. And we'll see you next time here on the Marc Oslar Retirement Experience.
Thanks for listening to the Marc Oslar Retirement Experience. To schedule a meeting about your retirement and the financial pathway to more, go to moretoretire.com. That's moretoretire.com.
Insurance products are offered through the insurance business Marc Oslar Retirement Experience. Marc Oslar Retirement Experience is also an investment advisory practice that offers products and services through Impact Partnership Wealth LLC, registered investment advisor. IPW does not offer insurance products. The insurance products offered by Marc Oslar Retirement Experience are not subject to investment advisor requirements. Investing involves risks, including the potential loss of principal. Any references to protection, safety, or lifetime income generally refer to fixed insurance products, never securities or investments. Insurance guarantees are backed by the financial strength and claims paying ability of the issuing carrier. This radio podcast is intended for informational purposes only. It is not intended to be used as the sole basis for financial decisions, nor should it be considered as advice designed to meet the particular needs of an individual situation. Marc Oslar Retirement Experience is not permitted to offer, and no statement made during the show shall constitute legal or tax advice. Our firm is not affiliated with or endorsed by the U.S. government or any governmental agency. The information and opinions contained herein are provided by third parties that have been obtained from sources believed to be reliable, but accuracy and completeness cannot be guaranteed by Marc Oslar Retirement Experience. Market Guard is a firm that provides investment signals as well as portfolio allocation recommendations for a wide variety of model portfolios. Market Guard does not offer advice or enter into fiduciary relationships. Please remember that converting an employer plan account to a Roth IRA is a taxable event. Increased taxable income from the Roth IRA conversion may have several consequences. Be sure to consult with a qualified tax advisor before making any decisions regarding your IRA.